Welcome back to Supernova. Hello and welcome back to our channel where we talk about all things finance and investing. Today's video is about the common investment mistakes that many people make and how to avoid them. Whether you are a beginner or an experienced investor, it's important to avoid these common pitfalls to ensure that your investments are working for you in the best way possible. So, let's get started. Number 1. Don't invest in something you don't understand. Don't invest in something you don't understand is a fundamental principle of investing. It means that before you invest your money in any financial product, company, or investment opportunity, you should take the time to educate yourself about it and make sure you fully understand how it works, the risks involved, and the potential rewards. Investing in something you don't understand can lead to serious financial losses. For example, if you invest in a company without knowing anything about its business model or financial health, you might not be aware of the risks and might be caught off guard by negative news or events that affect its stock price. Similarly, if you invest in a complex financial product, such as a derivative, without fully understanding how it works, you might not be aware of the potential risks or how to manage them. To avoid investing in something you don't understand, it's important to do your research and due diligence. This might involve reading financial reports, analyzing market trends, and consulting with financial professionals. Don't be afraid to ask questions or seek advice from experts who can help you make informed investment decisions. Overall, investing is a powerful tool for growing wealth and achieving financial goals, but it requires careful consideration and informed decision-making. By avoiding investments that you don't fully understand, you can help ensure that your investment portfolio is built on a solid foundation and has the best chance of success. Number 2. Avoid emotional investing. Avoiding emotional investing means making investment decisions based on objective analysis and a long-term investment strategy, rather than reacting to short-term market fluctuations or letting emotions guide your decisions. Emotions such as fear, greed, and excitement can lead investors to make irrational decisions that can result in poor investment performance and financial losses. For example, during times of market volatility, some investors may panic and sell their investments, fearing that they will lose even more money if they hold on. Similarly, some investors may become overly optimistic during a market boom and invest heavily in certain assets, only to be disappointed when the market corrects and their investments lose value. To avoid emotional investing, it's important to have a well-defined investment plan and stick to it, even when the market is fluctuating. This plan should take into account your financial goals, risk tolerance, and time horizon. It's also important to avoid making impulsive investment decisions based on short-term market trends or news headlines. Investors can also benefit from seeking out professional advice from a financial advisor who can provide guidance and help them stay on track with their investment strategy. By staying disciplined and avoiding emotional investing, investors can increase their chances of achieving their long-term financial goals and minimize the impact of market volatility on their investment portfolio. Number 3. Diversify your portfolio. Diversifying your portfolio means spreading your investments across a variety of different asset classes, industries, and geographic regions. The goal of diversification is to reduce the overall risk of your investment portfolio and to increase the potential for long-term returns. When you diversify your portfolio, you are not relying on the performance of a single investment or asset class to drive returns. Instead, you are spreading your risk across different types of investments, such as stocks, bonds, and real estate, as well as different industries, such as technology, healthcare, and energy. By doing so, you can reduce the impact of any one investment or sector underperforming on your overall portfolio. Diversification can also help to smooth out the ups and downs of the market over time, which can help you to stay invested for the long term. For example, during a stock market downturn, your investments in bonds or real estate may continue to perform well, helping to offset any losses in your stock holdings. However, it's important to note that diversification does not guarantee a profit or protect against losses in a declining market. It's also important to monitor and rebalance your portfolio periodically to ensure that it remains aligned with your investment goals and risk tolerance. Overall, diversification is an important investment strategy for managing risk and maximizing potential returns over the long term. By spreading your investments across a variety of asset classes and industries, you can build a resilient portfolio that can weather market ups and downs while working towards your financial goals. Number 4. Keep an eye on fees. Keeping an eye on fees is an important aspect of investing. Fees are the costs associated with buying, selling, and managing investments, and they can have a significant impact on the overall performance of your portfolio. It's important to be aware of the fees associated with your investments and to consider them when making investment decisions. Investment fees can come in many forms, such as transaction fees, management fees, and expense ratios. These fees can vary depending on the type of investment and the investment manager, and they can add up over time, reducing your overall returns. For example, a mutual fund with a 1% expense ratio will cost you $1,000 per year on a $100,000 investment, which can add up to thousands of dollars over the course of your investment horizon. To keep an eye on fees, it's important to read the prospectus and other investment materials carefully, and to compare fees across different investment options. Look for investments with low expense ratios and transaction fees, and consider investing in passive index funds or ETFs that offer low-cost exposure to broad market indices. It's also important to understand that higher fees do not necessarily mean better performance. In fact, many studies have shown that lower-cost investments often outperform their higher-cost counterparts over the long term. By keeping an eye on fees, you can minimize the costs associated with your investments and help maximize your overall returns. Over time, even small differences in fees can have a significant impact on your portfolio, so it's important to make informed decisions and be proactive in managing your investment costs. Number 5. Don't try to time the market. Don't try to time the market is a common investing mantra that refers to the idea that investors should not attempt to buy or sell investments based on predictions or attempts to beat the market. Instead, investors should focus on their long-term investment goals and adopt a disciplined approach to investing. Attempting to time the market can be a risky strategy, as it involves making predictions about the direction of the market based on factors such as economic indicators, political events, or market trends. These predictions are often unreliable, and attempting to time the market can lead to missed opportunities and potentially large losses. Moreover, timing the market requires both selling and buying at the right times, which can be extremely difficult to do consistently. Many investors who attempt to time the market end up buying high and selling low, as they react emotionally to market fluctuations rather than adhering to a long-term investment strategy. Instead, a more effective approach to investing is to adopt a disciplined approach that involves setting clear investment goals, diversifying your portfolio, and regularly rebalancing your investments. By investing for the long term and staying disciplined, you can help minimize the impact of short-term market fluctuations and increase your chances of achieving your financial goals over time. Overall, the key to successful investing is to remain disciplined and avoid making impulsive investment decisions based on short-term market trends or attempts to time the market. By staying focused on your long-term investment goals and following a disciplined investment approach, you can build a resilient portfolio that can weather market ups and downs while working towards your financial objectives. In summary, avoiding common investment mistakes requires doing your research, avoiding emotional decision-making, diversifying your portfolio, keeping an eye on fees, and avoiding market timing. By following these tips, you can increase your chances of success and achieve your investment goals. Thanks for watching, and we'll see you in the next video.